Good morning. I'm your host, Joanne Jobin with VID Media, and today we welcome Arizona's Sonoran Copper Company. We're here this morning with CEO George Ogilvie and his team, who will update you on the company's most recently announced milestone, which is their positive pre-feasibility study for the Cactus Mine Project in Arizona. Now, before we get started, I do want to remind everyone that if you have any questions for the company, and I'm sure there will be many this morning, please place them into the Q&A tab located at the top of your chat sections. We will answer as many questions as we can at the end of the presentation. So George, without further ado, the stage is yours.
Thank you, Joanne, and thank you to everybody for joining us here today with this prestigious announcement on our pre-feasibility study. I'm delighted to say that I'm joined on the call today by Nick Nikolakakis, the CFO of the company. Bernie Lawyer is also on the call, who is our VP of Projects. And Anthony Bottrell, our Senior Resource Geologist, is also with us on the call, should we get any questions specifically in those areas. We do make some forward-looking statements, so I'll draw your attention to the cautionary language. As everybody knows, when we look at the macro picture for copper on supply and demand over the next 10 years, you'll see that there's a structural deficit that will exist by the year 2030. This is being forecast from Wood Mackenzie. And of course, there are a lot of assumptions on the supply side that the new projects that are forecast to come in online will indeed come in online on time and on budget. Obviously, we've seen a lot of turmoil in the market as well, with today current producers having issues, particularly in South America. And as we know, grades are continuing to diminish. If we look at the pre-feasibility highlights, we put these results out yesterday, and we're showing all the numbers in US dollars, and we're using a flat copper price of $3.90 a pound in our model. That number comes from a consensus number of about 40 analysts who cover the copper sector, and what is their weighted average long-term copper price looking forward. I'm delighted to say that on an NPV basis post-tax, we're looking at a number of $509 million US. And you'll notice that the IRR after tax is 15.3%. A very important number for this project is the capital intensity, which essentially is the NPV over capital, which is showing at a 1-to-1 number. We have a 21-year mine life, and the payable copper over that period of time is 2.3 billion pounds of copper. And that equates to an average annual production of 55,000 short tons, or 110 million pounds of copper each year, which is double the average annual production produced in a PEA approximately 2.5 years ago. The capital, including a contingency of $75 million US, is $515 million, with 1.2 billion required in sustaining capital over a 21-year mine life. And I'll show you the breakdown of those numbers a little bit later. C1 cash costs are very competitive at $1.84 a pound, and all-in sustaining costs at $2.34 a pound. Total free cash flow, $2.4 billion, which equates to an annual basis of about $115 million US. Annualized free cash. Here you can see the revenue and EBITDA, but more importantly, we're also showing where the ore is actually being sourced from. And specifically, you'll see that in the first 7 years of production, we have very much focused in on the surface stockpile and Cactus West. The reason for that is that the execution risk is a lot lower than going immediately into underground mining. So to be very clear, we have not optimized this PFS for maximum NPV or maximum IRR. Had we done that, we would have pursued Park Salyer and Cactus East first. However, because we felt that the execution risk of underground mining as a startup company would be higher, we wanted to focus in on the less riskier surface stockpile and open pit mining. You can see that over 21 years, we generate $9 billion of revenue. And as we said earlier, $2.4 billion of free cash flow. Obviously, the sustaining capital is fully funded from cash flow from operations during the mine's life. As you all know, in the last 18 months, we've seen copper prices significantly higher than the $3.90, which we're using flat in our model. At a conservative $4.25 long-term copper price, we're looking at post-tax NPV8 of around $780 million with a 19% IRR and unlevered free cash flow of over $3 billion. And you'll notice that the NPV to initial capex ratio under that scenario now jumps to $1.5. You'll have all seen these numbers from October of last year, which is the resource that we put out inclusive of Park Salyer with all of the infill drilling. At that time, we highlighted the 4.4 billion pounds of copper that we have in M&I at 0.62 total soluble copper in situ. That is the number which will now feed through into the proven and probable reserves, which I'll show very shortly. I do, however, want to draw your attention to the 1.3 billion pounds of copper in the inferred category, which we are not allowed to include in the PFS, given it's only an inferred resource classification. Also, I'd like to draw your attention to the 1.7 billion pounds of copper in primary sulfide, which again is not included in this report, given that will require the Newton technology to be successful and for Newton to exercise their option to JV, or we would have to look at a copper flotation process at some future juncture in order to access that stranded resource. But I see that as a lot of optionality and could add a lot of accretion on a go-forward basis as we continue to advance our technical studies. I'm delighted to now report that from the 4.4 billion pounds of M&I, today we're declaring 3 billion pounds of reserves, mostly in the probable category. And you can see specifically there where it's broken out, with the higher grades being at Cactus East and Park Salyer, well in excess of 0.82% T-Sol. Now remember, because these are reserves, they incorporate dilution. This essentially is the head grade that goes on the leaching pad that we're recovering the copper from. Since acquiring the project in late 2019, the exploration team has done a phenomenal job in growing the resource from only 224 million pounds of copper in a surface stockpile to today in excess of 7 billion pounds of copper in the ground, of which we've said 3 billion pounds of that is now proven and probable. I would anticipate that over the next 2 to 3 years, this resource is going to continue to grow to in excess of 10 billion pounds of copper in the ground in Arizona on private land with access to water and significantly permitted. Remember, infill drilling at Park Salyer last year in the measured category was showing the company higher intercepts with better grades than what's in the model. This PFS does not include the Mainspring property, which appears to be the southern extension of Park Salyer, which is moving towards surface as we advance south. The gap zone, the 1 kilometer between Cactus West and Park Salyer, has never been fully explored at depth and remains open. And last year, you may remember, we drilled a metallurgical hole below the open pit all the way to the basement fault and found 200 meters of additional continuous mineralization in primary sulfide below the current or outside of the current pit shell. So in my opinion, there's a strong likelihood that the resource and eventually reserves are going to grow substantially here in the next 2 to 3 years. When we look at copper development assets in the US today, we believe with 7.4 billion pounds of reserve and resources, we would sit at number 6 as far as the top 10 are concerned. You'll notice in the table on the left-hand side, most of those development assets are held by the majors. Of course, I believe we compare well as well with Santa Cruz, which is immediately south of us. As you've heard me say before in previous presentations, if you take out the surface stockpile and Cactus West, the underground in situ grades are better than 1%. And we've now just shown with reserves head grade with dilution around 0.8 to 0.9 T-sol copper. Here you can see the production profile. And as I said earlier, you'll notice in the first 7 years, there's a focus really on mining the surface stockpile and Cactus West. We begin development into Park Salyer in and around year 1 and start seeing first ore coming out there in year 2. But we don't see the full ramp up there until year 7, when the production at Park Salyer then carries out to year number 19. You'll also notice later on as well that we start developing into Cactus East around years 6 and 7. That's in anticipation of the surface stockpile and Cactus West being depleted. And then we see Cactus East coming online in and around year 10. From year 10 onwards, essentially it's 2 underground assets carrying the production out to the end of the mine life. And here you can see in a little bit more detail what I've described in length, that there was very much a focus on this PFS to look at the execution of the plan. And we felt that going after the stockpile and Cactus West certainly is a lot more executable than going immediately into underground mining. Here you can see the plans for the Cactus West open pit. Over the first 4 years, on average, there's 28 million tons of waste being moved annually. And you can see in year 2, when we access the ore, it's approximately 12 million tons out to year number 7. That gives us a strip ratio of approximately 2 to 1. You'll also notice that on the east and southeast side of the pit, which is not colored, there's an opportunity to put the decline into Cactus East from the eastern portion of the current pit. Of course, we're going to start that up, as I've said earlier, in and around years 5 and 6. However, there's an ability to bring that production forward at any time in this production plan. You'll also notice on the top right that this is the surface stockpile. We intend to mine the surface stockpile initially in the east area. Then we would migrate to the west and eventually south. As we remove the surface stockpile, it creates more space for us to put in our leaching infrastructure, which I'll show shortly on the general plan arrangement. But to be very clear, the company has more than enough land currently for all of our current business needs and some additional expansion. Park Salyer and Cactus East will be mined both as sub-level caves. Park Salyer will be accessed through 2 twin declines starting from surface into the underground workings. It takes about 2 years of capital development to get into those workings. The first year is upfront capital. The second year falls into sustaining capital, given that we've already declared commercial production by then. There's approximately $100 million of capital going in those two twin declines to get into the top of Park Salyer. I'll explain why that's important when we get to the mainspring opportunity. Once we're at full production from Park Salyer, we'll be advancing the production at 6.5 million tons per annum, which equates to just under 18,000 tons a day coming out from the mine. One of the declines will purely be for a conveyor way. The second decline will be for moving men and material. Cactus East as a sub-level cave will be accessed via a single decline. There will be passing bays within that decline, which will allow trucks to pass one another. There's also a vertical conveyor that will be put in to move ore from the underground workings. In both of these mining scenarios, there will be an underground primary crusher that will crush the material down to 6-inch minus before it's ultimately conveyed to surface in the various conveyors. At peak production at Cactus East, we're running at 3.5 million tons per annum, which equates to just under 9,000 tons per day. Here you can see the general plan arrangement, which I referenced earlier. Initially, the leaching pad would go in on the right-hand side in the red area. And then, as I said earlier, as we remove the surface stockpiles, that will create further leaching pad space for us. Notice immediately to the west of the current tailings facility, there's an area of ground there which we call Arcus. That's about 1,000 acres of land, which is not currently being utilized on this plan. We get asked lots of questions about, do we have enough land to accommodate all of the leaching pads? And the answer is yes. You'll shortly be seeing a further announcement as well with respect to additional land that we have just picked up from the Arizona State Lands Department, and that will add an additional 500 acres of land to the project. Metallurgical recoveries, as you know, we've been doing over 2 years of testing now. Within the model, we're using recoveries ranging anywhere from 85 to 92% on the oxides. There is an opportunity that we've seen through the Newton technology where we actually see marginal improvements in the extraction recovery rates for the transitionary or the enriched material. But for us to realize that accretion, it will require the Newton technology, obviously, to work in this phase 2 column test and ultimately for Rio to decide to exercise their option to JV. Now, here we get into the capital numbers. And before delving into these numbers, I want to come back to the PEA. Many of you would have heard me say in the past that when the PEA went out 2.5 years ago, it was a PEA and it was looking at taking run-of-mine ore from the open pit and underground, putting that in 150-ton trucks and driving it up onto a leaching pad. The capex for that was $124 million US, and it had a production profile of 28,000 short tons of cathode production a year. When we went into detailed metallurgical testing, which has been ongoing now for over 2 years, we look at the size fragmentation of the ore to try and determine what size of ore is required to optimize recoveries and what gives us the biggest benefit in the financial and economic model. And we quickly realized that 1 inch minus to 3/4 inch minus passing 80% is the optimum size to get better than 80% recovery on this ore body. Subsequently, the PEA did not include primary or secondary crushing fixed plant equipment, which is in this PFS. Our ore also generates fines, and there are fines in the surface stockpile. So again, the PEA did not envisage agglomeration drums with respect to the fines. Those agglomeration drums are now built in to this capex number. The other thing you want to avoid is driving 150-ton trucks up on top of leaching pads because it causes a lot of compaction over the first 10 feet of the leach pad, essentially creating like a concrete block. There is no way you can irrigate the copper and leach it out if you're trying to get sulfuric acid through a 10-foot block on top of your leach pad. It then requires an operator to come in and basically rip the top of the pad, which is never a good idea. So the way around that is you keep the heavy equipment off the pad and you have to convey and then use radial stackers with your material to deposit it onto the pad and keep heavy equipment off the pad. Had the PEA been done with all of this fixed plant equipment 3 years ago, the real capital costs for the PEA would have been $250 to $300 million, which would have put us in and around $10,000 to $12,000 a ton in capital intensity. So these numbers of $515 million should not be a surprise to the market, given I've made it abundantly clear that that is what happened in the PEA. Obviously, in the last couple of years as well, we have seen inflationary pressures, and those numbers are now built into this capital, including a $75 million or 17% contingency. The numbers we've put out today are very realistic and are real life if we want to put this mine into production in the next 2 to 3 years. I think it's also very important for the listeners to understand that the company has no intention of project financing this project on the back of this PFS. You'll see from a schedule that we're going to touch on, the definitive feasibility study won't be out into the market until the summer of 2025. And by then, we would expect further accretion from all of the opportunities that we have. And we think that we're going to be in a very different copper environment and general economy, better general economy than what we see today. When we look at that capital intensity versus a lot of our peers, you'll see that we're sitting in the bottom quartile, i.e. between $9,000 and $12,000 a ton of cathode being produced. Think back to that PEA, $124 million and 28,000 tons. That would be a capital intensity of under $5,000 a ton. There are no copper projects in the world today, I can guarantee you, that are going to be built for $5,000 a ton capital intensity. And if you hear that from anybody, you should run the other way. Here you can see the production profile again with the operating costs at $2.34, all-in sustaining, and C1 at $1.84. Notice how there's a rise in the ASC in and around year 8, 9, and 10. That's because of the capital development going into Cactus East with respect to that decline that I pointed out earlier on at the bottom of the open pit in the southeast corner. When this mine goes into production and it's producing 110 million pounds or 55,000 tons of copper on an annual basis, today it would rank number 7 in the US as far as the largest copper producers. Remember, this is copper cathode that is going to go right into the US domestic supply for copper. It's not going offshore for any further smelting or processing and then coming back. We believe this is going to be highly prized domestic product for the US in the next couple of years. When we look at the after-tax NPV to initial capital, a ratio that we normally look at is, where does that actually sit? And anything that's above 1-to-1 or above 1 is normally at the higher end or the better end when compared to the market. And you can see that we sit right on that 1-to-1 NPV to initial capital. Now, we touched on this earlier, but in this PFS, we are not allowed to include an inferred resource, which is 1.3 billion pounds of copper at almost the same grade as the M&I. If we assume a conservative 50% conversion of inferred to M&I and eventually into the production plan, that would give us an additional 500 to 600 million pounds of additional copper. And at 100 to 110 million pounds of annual production, that would add another 5 to potentially 6 years onto the mine plan. So if you ask me today, what is the mine life of this actual mine? With no exploration success and only infill drilling, today we are looking at a 26-year mine life. And we will have a lot more exploration success, as we're about to demonstrate with the Mainspring property. So the PFS is now out. At the end of this month, at the end of the first quarter, Mainspring will be in an inferred resource category. Our intention is to continue drilling there to bring it out into the indicated category. And at some juncture in the summer, we will come out with an updated mineral resource estimate, which will include the Mainspring property. That will then feed into an updated PFS that will include Mainspring. That becomes the standalone plan that the Newton integrated PFS would be then judged upon. And any of the assumptions that we use in our own PFS, such as copper price, exchange rates, etc., they have to be included in the Newton integrated PFS. So we have a direct apples to apples comparison. We have embarked on a PEA with Newton, and of course that should come out sometime this summer, and it will also include Mainspring, because by that time Mainspring will obviously categorically be an inferred resource, and it will give the market at the first look at what type of accretion could we see with Newton coming into the equation. Remember, 1.6 billion pounds of copper in primary sulfide. There's almost 1 billion pounds of that situated at the bottom of the Cactus West open pit. We're mining the open pit in the first 7 to 8 years. The likelihood, if Newton works, of significantly increasing the production with the primary sulfides is very high. We all know that if we can bring production forward and increase cash flows in the first 10 years of the mine life, the accretion on the project is going to grow significantly. The other key aspect of Newton is that it takes advantage of the existing infrastructure or a standard SXEW plant and leaching pad. So you could see a 50 to 100% uplift in production, but you're not going to see that as far as capital is concerned. The capital increase would be incremental, because you would be looking at maybe an additional shovel in the open pit or an extra fleet of 150-ton trucks, but you're not going to see a doubling of the capital under the Newton scenario. You're all aware the company has significant benefits given its infrastructure. And of course, we benefit from that in that we don't have to build roads. We don't have to put in a power line. There's a rail line there. We have access to water. The city of Casa Grande is right next door with 55,000 people. We're not building a camp here. There's a lot of other copper projects out there in the world, development projects, that do not have the luxury that Arizona Sonoran has for putting a mine into production. I think importantly as well, we also have a very strong social license on this project. And you're going to see some news coming out in the next 2 to 3 months that will actually support the statement that I'm making with respect to the social license that we see from the local community. We did complete, obviously, a survey about 2.5 years ago. And at that time, with 500 respondents, 83% were supportive, including 67% of Democrats, of seeing this mine come back into production. As a reminder, the Cactus permit today, as per that old PEA, is fully permitted. We've now made out the applications for an amendment to the permits as per this PFS, inclusive of Park Salyer. We would anticipate having those permits in hand sometime before the end of the third quarter of this year, which is when the updated PFS comes out, but obviously now well in advance of any definitive feasibility study that we're not envisaging until the summer of 2025. For those listeners who haven't heard me speak before, what benefits us here is that this project is all on private land. There's no federal nexus, and we're only dealing with the local state authorities, mainly Arizona Department of Environment and Quality, Arizona State Lands Department, and the local municipality, who have been very supportive to date of the project. So let's touch on Mainspring. We've put out 11 holes late last year. I can tell you today we're now drilling holes 42, 43, and 44 with 3 drill rigs. The last couple of holes are being drilled as we speak on the inferred resource. We're seeing mineralization as we extend south coming towards surface. And the closest intercepts we've had to surface are 42 meters, which is about 150 feet deep. And those holes are 750 meters south of the property boundary between Park Salyer and Mainspring. Now, why is Mainspring potentially important? Because if there was an open pit at Mainspring and we started the starter pit in the south, we advanced it to the north and gradually got deeper, eventually there's an opportunity to bring the pit right in on top of Park Salyer. And if that was the case, we would have the option of looking at mining Park Salyer either as potentially an open pit itself or accessing it from the bottom of the Mainspring pit. If we were to do that, the $100 million that I referenced earlier, which is going in the 2 declines in this current PFS in and around year 2 and 3, that $100 million of capital is not required, because essentially you've mined the open pit, which would generate free cash flow to get in on top of Park Salyer. You also push out the underground mining, which, let's be honest, it carries higher execution risk when it comes to open pit mining that generally is lower capex and lower operating costs. So as you're all aware, we signed an agreement late last year, which was an option to JV with Rio Tinto Newton, which is a division within their copper division. The company gained access to $33 million in non-dilutive, non-equity funding. I'm happy to say that we've already received $18 million from Rio Tinto, with an ability to draw another $15 million over the course of the next 10 months. The company is now sitting with in excess of $20 million cash in the bank today, and no requirement to come to market. When we look at the valuation metrics, we're currently trading, or at least we were a couple of days ago, at under 2 cents a pound of copper in the ground based on an equivalent value. You can see that's well below the 8 cents enterprise value compared to our peer group. And when we look on a PNAV basis, we're currently trading at 0.2 times, again, significantly below our peer group. And obviously, when you look at the ability to bring the mine into production, based on everything that I've brought forward, I think the chances are very high that this mine will go into production sometime in and around 2027. And again, this is a more updated peer review analysis. We've updated these numbers since the release of the PFS. You can now see it's 7.5 billion pounds of M&I in the ground. It stacks up very favorably with our immediate peers. I would also say Arizona, on private land with access to water and a brownfield site, is probably the #1 jurisdiction on this page. And from a capital intensity perspective, this is one of the lowest capital intensity projects today in the world. Why is that important? Well, it's important because we've seen many projects get built and there are huge capital blowouts. So let's just assume that this project in the next couple of years gets financed. It's a $500 million spend and there's a 20% blowout. In that scenario, the company would be looking for an additional $100 million of financing. If you're building a $2 to $3 billion project and you have a 20% blowout, suddenly now you're looking for $400 to $600 million, which is a much, much bigger hole to try and fill. And we're seeing a lot of companies run into those problems today. This is why this capital intensity number, it's a number to focus in on, because at $10,000 a ton, this signifies low risk execution in putting this into production. So 109 million shares issued. I believe today we were trading around $1.10. That gives us a market cap of about 120 million Canadian dollars. It's essentially the assets of the company and the cash we have in the bank. The 7.5 billion pounds and 3 billion pounds of reserves, in my opinion, are getting zero value today from the market. So just to recap, we believe these numbers are very robust and they are realistic. It's 55,000 tons or 110 million pounds of copper over 21 years on private land in Arizona with significant permits in place. 9 billion pounds of revenue and free cash flow of almost 2.5 billion. This project, if it sees $4.50 or $5 a pound of copper in the next 5 to 10 years, these numbers will grow astronomically, as we showed in the sensitivity table earlier. This company is very, very undervalued, despite the quality, the economics, and the low risk. And of course, it's all driven by a very experienced management team that's got a proven track record in difficult circumstances in the past with troublesome companies that have been turned around and made a lot of accretion, a lot of positive value for the shareholders of the company. That is not going to stop today with Arizona Sonoran. So look, that concludes the presentation. I know we've covered a lot, but Joanne, I'm happy to open up the floor and answer any questions that anybody may have at this juncture in time.
Thank you very much, George. That was an excellent update. We have an absolutely packed full room this morning. So I'm going to start with some of the first questions, and that is, what are your life of mine projections for electric power cost?
Well, in the model, we use 7 cents a kilowatt hour. Obviously, we had to get a quote on that. So we went to the Arizona Power Service, APS. We gave them the power load that we envisage for the current project based on this PFS. And based on the range and the loads that we would be using, it comes out at 7 cents a kilowatt hour. Those numbers can change with further engineering studies. The more load you use, you can actually drive those numbers down because you get the benefits of economies of scale. And as I referenced earlier, the beauty of this project is that there's a nuclear power reactor in Arizona with one of the main transmission lines running right through this project. So we've also got the ability to draw clean 100% green energy from that main transmission line.
Excellent. Thank you, George. Next question. Has the phase 2 Newton work started? And if not, is there a tentative date to begin?
Bernie, maybe I could throw that one over to you so you can introduce yourself to the market.
Thanks, George. The schedule for the phase 2 program, which is agreed to in all the various elements that make it up, that actually kicks off in June per schedule. And of course, what that's going to require is core sampling from both Cactus West and Mainspring. Mainspring core will be achieved in early April, and the core out of Cactus West as we approach May. And so we'll be loading column cells as we enter the summer.
Thank you. Next question. Can you talk about the timing of the Mainspring resource and PFS, along with the impact on the project economics versus the current PFS?
Well, I can jump in there. As I touched on in the presentation, at the end of this first quarter, we'll have all the assays back on Mainspring, and therefore we'll have an inferred resource, which then can be fed into the Newton PEA that we spoke about earlier in the schedule. Our intention is to continue drilling Mainspring over the next 3 months to bring it up into an indicated resource. And we believe by the summer of this year, we'll be in a position to put out an updated mineral resource estimate that would also include some of the infill drilling we did last year at Park Salyer and a little bit at Cactus East, Cactus West, moving up into the measured category. That then feeds in, that MRE would then feed into an updated PFS, inclusive of Mainspring and the indicated category, sometime before the end of October of this year. Don't quite know the impact on the economics with Mainspring. It's still a little bit early, but we do know, as I made a general statement, that open pit mining generally has lower capital requirements than going underground. Usually the operating costs, the cost per ton, cost per pound are lower. There's obviously much less execution risk. And I do know that there's $100 million of capital development into Park Salyer over a 2-year period that would not be required if Mainspring became an open pit and ultimately advanced north to coincide with Park Salyer.
Thank you, George. There are a lot of questions regarding the IRR and reducing the payback period. Can you comment on that, please?
Yeah, absolutely. Look, one of the things we're seeing around the world, particularly with copper projects, copper projects typically tend to have decades of life. And over the last 5 or 6 years, we've seen a lot of inflationary pressure coming on capital costs and operating costs, et cetera, et cetera. The days of seeing copper projects with IRRs of over 20% at copper prices sub $4 are over. Even the CEOs of all the major companies are saying that to the market, that they're not looking at organic growth opportunities and spending $2, $3, $4, $5 billion to go and organically grow their business if they don't see copper prices well north of $4 a pound copper. And that's what we need in this copper environment to realize IRRs after tax in excess of 20%. There's been a complete paradigm shift here in the world. And unfortunately, a lot of people haven't realized that yet. And if we want to see the copper be there for the demand, which is coming, we're going to have to realize a lot higher incentive prices than what we're seeing today or what we're using in this model. And it comes back to the point that I raised. We have no intention of raising money to project finance this project on these economics or on this copper price environment that we're showing here today. But my job as the CEO is to plan ahead for the next 5 years and try and determine what's the best strategy for the company and put ourselves in a position so that when the market turns and we see more robust pricing, all the pieces are in place to move this into production expeditiously when there's going to be huge demand in the US for copper.
Excellent. Question, which NPV discount rate, copper price, etc., is used for the calculations of the Newton JV?
Well, as I touched on earlier, when we get to the Newton scenario, we have to use all of the same assumptions that we use in our own PFS, whichever PFS that is, whether it's this one or whether it's the updated one at the end of October, because we need to see the comparison on an apples to apples basis. It's not to say that we might not put out an integrated Newton PFS with a $4.25 copper price if that's the long-term forecast at that juncture in time. But when we do the comparison of that PFS to our own, everything would be run today at $3.90, a 1.35 exchange rate, and an 8% discount factor. So as much as possible, it has to be an apples to apples comparison.
Thank you, George. The next question, are there any concerns with you being so close to Casa Grande? And also perhaps comment once again on the labor force.
Well, obviously since acquiring the project 3.5 years ago, we've had to have land rezoned from residential over to industrial. That zoning process has gone through city council meetings and hearings. Lots of people from the public were there because they're also dealing with city matters like sewage and parking issues or commercial real estate. We've answered lots of questions from the community on what are we going to do to abate dust, noise, where are we getting our water from? We've addressed all of their concerns, and in the meantime, all of our permits and rezoning has gone through unopposed. So we believe we have a very strong social license from the local community to see this mine coming back into production. And in the general plan arrangement, you'll notice to the north and the northeast of the property, there's what we call a view shed berm that we're going to build. Essentially, it's 30 meters high. It wraps around the entire perimeter. And the waste material that will come from the Cactus West open pit, that's that 24 million tons annually over the first 4 years, that goes into the construction of the waste view berm, which then shields that closest community from the dust, from the noise, from people being able to see into the mine.
Thank you, George. All right, we have one more question on the NPV.
Thank you, Joanne.
And that is, what would it have been if the sequencing was PS before Cactus? Sorry,
I missed that, Joanne. Could you repeat?
Yes, 1 second. The question is, what would the ballpark difference in NPV have been if the sequencing was PS before Cactus?
We'd probably be looking at somewhere around 100 to 150 million US dollars differential on the upside had we gone after Park Salia first and Cactus East and pushed out Cactus West to the back end.
Okay. A couple of other questions outside of the announcement. What were the silver and moly grades mined by ASARCO?
Well, that's a great question. I'm going to ask Anthony to maybe jump in here. Hopefully he's got that in his data bank.
I don't have the exact figures, but on silver, it's probably around 2 grams silver. And for the moly, it's probably about 0.2 to 0.3%. As a leachable project, we can't recover that material though.
And there was some gold as well, wasn't there, Anthony?
Yeah, over the life of the mine, a 10 to 12 year period, there's about 25,000 ounces recovered on the gold side.
Yeah, look, we don't show that, but we all want the Newton technology to work. We think that could be hugely accretive for the shareholders of the company. And we're working very close with our JV partner, Newton, which we've absolutely been delighted with over the course of the last 18 months as they have assisted us with our project. So we want to see the Newton technology work. If in a worst case scenario it doesn't, and we put this mine into production for the leachable oxides and the transitionary material that we ourselves can actually leach, I do believe that we will see much, much higher copper prices in the ensuing decades. And there will be an ability to go back at some stage and look at a copper flotation mill or some form of flotation to actually gain access to the chalcopyrite or the primary sulfide. It's just that we cannot look at it at this juncture in time. A typical capital intensity for a copper concentrator would be more around $20,000 a ton, which would mean that the capex on this project would therefore be looking at around $1 billion.
Thank you, George. And one of the final questions we have is, what is the company policy on blackout for management insider purchase after a major announcement such as the PFS?
I'm going to ask Nick Loukakis, my CFO, to jump in there.
Thanks for the question. Generally speaking, we have a blackout period 2 weeks before an announcement. And depending on the circumstance, it's generally a few days to a week post the announcement.
Thank you, Nick. The next question, which is one of the questions that I had, is that can you please explain exactly what the Newton process and the deal means to Arizona Sonoran?
Yeah, okay. Well, look, the option to JV we signed allows Newton, if they're able to satisfy certain financial triggers, to earn in up to 40% at the asset level. So what I mean by that is that, let's just say, and we'll round up the numbers, with this PFS, the post-tax NPV is $500 million. Under this scenario, without mainspring, under the integrated Newton PFS, Newton would have to realize a 1.39 times uplift in the net present value of the project on using all of the same assumptions. If you take 1.39 and you multiply it by 500 million, it's going to give you a number just under $700 million post-tax is what Newton would have to deliver in order to have an ability to exercise their option to JV. If that were to happen, and they're coming in for 40% of the project, they need to pay the Arizona Sonora shareholders for 40% of the base case value of the project at a 0.65 times PNAV multiple. And I think on the call today, we just showed that we're trading at 0.2 times price to NAV. So if we work through the math again, $500 million base case NPV times 0.4 is going to give you $200 million, and times 0.65 gives you $130 million. So they would be providing ourselves at that juncture in time with $130 million. Now, if we go to the other side of the equation and we look at project financing, and again, I'll just use $500 million of CapEx for easy math. As I said earlier, incrementally, it may be a little bit more than that, given the production profile would increase. But with a doubling potentially of production, we're not doubling the CapEx. So 500 million CapEx requirement, each party is responsible for their percentage share of the ongoing costs, including project financing. So Newton would have to fund 40% of 500 million, and we would have to fund 60% of 500 million. 60% of 500 million is $300 million. And if we split that, 50% debt, 50% equity, we would be looking to raise $150 million US in equity. But if we've been given approximately $130 million from Newton for them to earn in at 40%, the delta is only $20 million US dollars or 30 million Canadian dollars. Given our financings in the last couple of years have all been conducted at $2 Canadian, essentially I would only be issuing another 15 million shares to raise that 30 million. Now, on the debt side, if we were looking to raise $150 million worth of debt, given that Rio Tinto is putting their money where their mouth is, and they're providing a completion guarantee on the project or a performance guarantee on their technology, the likelihood of getting low capital debt financing from a commercial bank is probably quite high, given Rio Tinto is supporting the project. The other thing we built into the agreement was that if we're unable to secure project financing on reasonable terms, then Newton and or Rio Tinto has to step in and provide us with that debt financing at commercial terms, reasonable commercial terms to be negotiated at a future juncture in time. In my opinion, if Newton is successful, essentially from a financing perspective and from an execution perspective, we have completely de-risked this project. This PFS that we put out today is purely a stepping stone to further accretive studies. And I can assure the listeners on the call that the management, as per our track record, will be working on financing solutions for the go-it-alone plan if Newton is unsuccessful, that will be just as accretive for the shareholders of the company. But rightly or wrongly, we felt that putting out realistic results to the market that are credible is much, much better than relying on a PEA that really 3 years ago is completely out of date and is not realistic as to what this mine will actually be. And having material information, rightly or wrongly, we've got to put that out into the market. And I believe there is huge upside in the valuation of this company as we go forward in the next couple of years. Just be patient.
Thank you, George. Excellent. And again, you know, when you look at the capex of copper projects across the world, particularly in Latin America, which are billions of dollars, this seems like an incredibly reasonable route to go. You know, from my experience and from my learnings in the mining industry, I've been here, as you know, a few years myself. But that's just an incredible update. Thank you very much, George. I think we have one more question before we depart today, and that is, what would be the impact on OPEX/sustaining capex of Mainspring and or Newton? Would that be more or less in line per pounds of copper to the current OPEX sustaining capex per pound?
It's difficult to answer that, Joanne, but I'd probably say that given the significant uplift in production with Newton that we're likely to see, and I referenced this earlier, you know, when we do that open pit layback at Cactus West and we mine the leachable material, the oxides, there's 1 billion pounds of primary sulfides sitting there exposed, waiting to be mined. You've already did all of the layback, you've bought and paid for the infrastructure, so the margins on that material are going to be extremely high. And I think this Arizona Sonoran shareholders will benefit from that significantly. So based on the economies of scale, I'd say all of our unit costs on a per ton or a per pound basis are going to be driven lower, and the margins are going to increase significantly. And, you know, as we indicated in the presentation, the PEA with Mainspring, but importantly with Newton incorporated in, will be out this summer. And that'll be the market's first look at what type of accretion and what can Newton do for the production profile of the company. And, you know, as a CEO, I touched on this earlier, but I've got to look at the bigger picture story as well. We know there are other mining companies or developers within the region, and we know that the mineralization of their deposit essentially is the downplunge extension of the same mineralized system that we intend to mine and that ASARCO mined 30 and 40 decades ago. The technology we're deploying on our site and Newton, if it works on our deposit, the likelihood is it will work on a regional scale as well with other deposits right next door. And when you start to consider about a regional roll-up in this area, 20 billion pounds of copper in the ground on private land with access to water, that to me is a world-class asset in Arizona with infrastructure in place and a community that is giving you a social license. That has to be worth several $1 billion in the next couple of years.
Yeah, unheard of in this day and age as well. So well done, George. So we're now at the top. You're welcome. We're now at the top of the hour, and so we're going to end our town hall forum. But before we leave, George, I know you've spent a lot of time today explaining this PFS, but perhaps you'd like to say a few words to your shareholders and audience members who've joined us this morning.
Yeah, to the shareholders of the company, thank you ever so much for your continued confidence in the management of the company and your patience. As I said, this PFS that we put out today is not the final product. It is merely a stepping stone to something bigger and better and more accretion and value for the shareholders of the company. I believe anybody who's looking at copper more medium and longer term and is looking for copper development exploration stories in safe jurisdictions that have an actionable action plan of relatively low risk, I would absolutely put Arizona Sonoran Copper Company at the top of the list. This has to be one of the top copper development, undeveloped copper stories in the world today for a critical metal where the demand is only going to increase exponentially.
Thank you, George. And thank you, Arizona Sonoran, for joining us today, and the entire team of Bernie and Anthony, George, Nick, and Allison. Thank you. It was a great day. We had an amazing full room. And just a reminder to everyone to please fill out the quick questionnaire before logging off, because this helps us and the company to communicate more effectively with you. And should you have any further questions for the company, you may email them directly to Allison Dwoskin at adwoskin@arizonasonoran.com. Thanks to everyone who joined us today, and we look forward to hosting you on the next Town Hall Forum. Goodbye.